Few people look forward to doing their taxes, but finding extra deductions can make the process a bit more enjoyable. Peter Cishecki from Everything Financial joins us this morning with a few ways to make your mortgage interest tax deductible. Peter, people are probably wondering, are we even allowed to do this? Is this something that is legal through the CRA?
Completely legal, Carrie. Good morning, by the way. Completely legal with the CRA. There is some rules and steps you have to follow, and you have to follow them in perfect order and do them right. Because if you suddenly go from not deducting your interest, and a year down the road you have this massive deduction for interest, they're probably going to come asking questions, and they will, because they want to make sure you're doing it the right way.
Right. So you might have a lot of eyeballs on your tax return. So, okay, you got to do this right then. Tell us a little bit about what the 31-day rule is.
The 31-day rule is something that Supreme Court of Canada put in back in the late 90s. So if you take a chunk of money, you just have money in the bank or money in savings or whatever the case may be, and you pay down a large portion of your mortgage, you have to wait 31 days. That's the rule. So maybe wait 35 to be safe. And then you can take that money back out of your mortgage and invest it in what's called a non-registered or a taxable account. And suddenly, just like that, that portion of your mortgage, the money you pulled back out, the interest on that portion is now tax deductible every single year, as long as that money is in an investment account that, again, is non-registered or what's called a taxable account.
I'm just going to guess that that's the kind of thing that you might need someone with the tax knowledge to be able to pull off. Because, I mean, if you do your own taxes, that sounds a little bit complicated.
Yeah, you're suddenly adding some extra deductions, and you have to know where to put them in the right spot. And you have to keep a record, too. You have to show that, okay, the money was deposited to my mortgage, so take a screenshot of the payment and the date, and then the 31 days or 34, 35 to be safe later, you show the money coming out and going into the investment, and it's got to be the right type of investment. It's got to be recorded properly. So you need probably a registered financial planner and an accountant together, teamwork, to make sure you do the deduction properly and you record it properly.
Okay, so is the interest tax deductible from your mortgage no matter what the investment that you have?
No, good question, Carrie. It's not. If you take that money back out of your mortgage after the waiting period and you put it into a TFSA, tax-free savings account, or you put it into an RRSP, it is not tax deductible. It has to be deposited into something that is non-registered, or as we say, a taxable account. It could be put in, not that you would because you'd make no interest, but it could be put in a GIC for that matter. It's not the investment that's key. It's the type of account, but the investment does have to earn like capital gain, dividend, or interest. It has to be appreciating. But the key part, first off, is non-registered taxable account. And there's a great link on CRA's website to explain exactly how it works. It's actually quite easy to do. And even if you do it with as little as $25,000 to start, it's just going to keep growing every year. Any amount you can do that you can get money back from CRA and deduct that biggest thing, the interest on your mortgage, or at least part of it, you're going to come out ahead in the end.
Yeah, people are always looking for any way that they can get as much money as they can back from the CRA. I imagine people are always approaching you about trying to find those loopholes.
Yeah, and loophole, but it's one of those things that people don't know. Now, here's the one thing. If we've talked before on the show, and I talked about this, about portfolio management, investments versus mutual funds, etc. We're not going to beat that to death today, but with portfolio management, you have the management fees that are fully transparent, disclosed, and you're also allowed to deduct those fees in that account as well. And unfortunately, you can't do that in a mutual fund. You can still put the money in the mutual fund, but you don't get that extra deduction of the fees like you do with the investment counsel planning model, aka a portfolio manager. So one extra deduction over and above the interest, and you know what? That never hurts. That's going to put more money in your pocket.
Peter Cishecki, Everything Financial, with good advice this morning. Thanks, Peter. Have a great day.
Thanks, Gary. Have a great day.